Sounds good.
This meeting is being recorded.
Good afternoon, everyone, and welcome to our Investing 101, Investing Made Easy at any age webinar today. And with us, we have our experts from Charles Schwab, and we have Carlos Rodriguez and Keenan Kavanagh with us today. And we're very excited that you're able to join us. And we know that you have a lot of great information to share. So I will let you guys take it over from here. Thank you.
Thank you. Welcome, everyone. Again, my name is Carlos Rodriguez. I am currently the manager from Schwab's International and Advisor Risk Projects. I have a BBA in Management and Finance. I've been working in finance for about 8 years now. I started working in general financial services. Then I moved over to alternative investments, operational risk and control. If those don't seem familiar, that's normal. Not a lot of people know about it. Basically, what I do is, as you know, our industry is under a lot of regulation and audits. So my team and the teams that I've been on kind of make sure that everything is in good order and according to regulation, if that makes sense. Now I'll pass it over to my colleague Keenan, so he can give us a bio of himself.
Yeah, thank you all for joining. It's great to be here today. As Carlos said, my name is Keenan Kavanagh, and I am in a VP financial consultant role with Charles Schwab in the Twin Cities, Minneapolis area. So I work with clients directly on their financial plans and helping them with investment strategy and planning out their financial lives. So been with Schwab a little over 3 years now. Prior to that, had some experience working with other registered investment advisors, and I've also got my certified financial planner designation. So I'm very well aware of the topics we'll be discussing today. And with that, I'll kick it back to Carlos here to continue the presentation on our 7 fundamentals you need for investing success.
Well, I think you're going to give us.
Yep. And then, so just a little bit of background first, actually, on our company. Charles Schwab was founded over 40 years ago with the goal of democratizing finance and bringing low cost to individual investors. And we still have that goal today with 3 main areas that we focused on and believe in, and that is the power of investing to transform people's lives. We believe that cost matters, so bringing a low cost option to everyone. And the third, that investing should be available to everyone and at as low of a cost as possible. With that, if you are reading the screen here, you'll see that 4th box says we challenge you to challenge us. So we will have time for questions at the end of today's presentation. And we welcome any questions that you have at all. And we really do challenge you to give us some tough questions maybe, because that's where a lot of the learning can begin. Now I will actually kick it to Carlos to discuss the agenda and some of our investing principles here.
So yeah, today we're going to be going over starting with a financial plan that reflects your goals, implement your plan with your core investing principles, and monitor your results and stay on track. So nowadays with the internet, there's no shortage of information that we get about our approach in investing. You know, there's news all the time, there's stuff going on, but what's important is to get accurate information that is meaningful to you as an investor, and to have resources to help you walk through your plan and put it into action to achieve your financial goals. Today, we're going to look at a few essential principles to help you take ownership of your investment portfolio and drive your investment plan. So these are the 7 principles. They were developed by the Schwab Center of Financial Research. It's not something that me and Keenan are just coming up with. It's a time-tested, straightforward approach to investing. The fundamentals are, like we said, establishing a financial plan based on your goals, start saving and investing today, build a diversified portfolio based on your tolerance for risk, minimize fees and taxes, build in protection against significant losses, rebalancing your portfolio regularly, and ignoring the noise. So now Let's begin where every portfolio should, establishing a financial plan based on your goals. So planning can help you identify what's important. It can help you resolve conflicts that can come up when priorities bump up against each other. And when you follow your plan, it can help prevent backsliding. So with all this being said, what's involved in putting your plan together, and how do you review the one you have? What can you do to give yourself a better chance of achieving your goals? So keep these 3 steps in mind. First, be realistic about your goals. Planning starts at being specific and knowing where you want to be. For example, let's say my goal is to retire without having to work. That's great, but we need to determine if it's a realistic goal and create a plan to help us achieve it. So you'll need to add important details, such as how much money am I going to need and by when. Starting with this information, you can begin to assess how achievable your goals actually are and what steps you've already taken and what you need to do next. The second key is to review your plan at least annually. Once your plan is in place, how do you know if it's working or not? You'll have to set some, as I said, a specific saving and investing goals for yourself during the planning process, and take a look once in a while if you're getting to the point that you want to be. For example, have you been saving as much as you want every month? Did your investments perform the way you wanted them? If things are not going the way you planned, what do you need to change? Maybe your savings or investment goals are too aggressive or too conservative. Rather than get discouraged, you may need to set more realistic goals. We recommend reviewing your plan at least annually, ideally quarterly. The important thing is to remember that it's a plan, not set in stone. It's a guideline that should change with your circumstances, which brings us to the third point, which is changes, what to make of changes in your life and circumstances that change. What happens to your plan for retirement if you're offered an early retirement plan, or let's say you take a job that pays a lot more money? We all have unexpected events in our lifetimes that can have substantial financial impact, and these may impact our plan. It's important to review your plan and make any necessary adjustments as your life changes. You may be feeling like planning it's a lot of work, which is true, and it takes time, but it can have a significant impact on your confidence, and it's always better to know where you stand. So on the next slide, it kind of shows a broad way to show that those who actually have a plan compared to no plan do significantly better. And that's just like stuff doesn't kind of fall together. But anyway, I'm going to pass it to the principle number 2, back to Keenan.
Yeah, thanks, Carlos. So the second principle is to start saving and investing today. And so obviously you've all heard of the time value of money, and there's a couple examples here that will show that. But first step is to save. And so obviously, as Carlos said, in the financial plan, it's important to be realistic about your goals and about what you can afford to save. But starting as soon as possible is important because there is a large effect to the time value of money. And so starting sooner can have a profound impact. So you want to maximize what you can afford to save, but again, be realistic and know that timing the market is really, really hard to do. We don't know when a market correction or a bull market is going to happen necessarily. It's really hard to predict, but total time in the market can have a tremendous impact on your overall success. So we always like to say time in the market, not timing the market. So that's an important thing to keep in mind. And there'll be an example here in a moment of 2 hypothetical investors here, Maria and Anna. Both of these investors contributed the same amount of total dollars. Both of them are investing $30,000. Maria got started a little earlier, however, so both are investing exactly $3,000 a year for 10 total years on January 1st of every year. But if you start a little bit earlier and then you don't invest anything for the second 10 years, in a total of 20 years, Maria is able to accumulate almost twice as much in an investment account as Anna, who started after 10 years after Maria, even though they contributed the same dollar amount. So that just is kind of an example to show you that starting as soon as possible with saving towards your goals can have a profound impact, and not trying to time the market and just trying to get as much time as possible in the market. As we'll see on this next slide, if you do try to time the market, you might actually end up hurting yourself a little bit. This is from data from the year 2020, where if you miss the top 10 performing days in the market, your portfolio performance would be drastically reduced. So being in the market the entire year in 2020, you would have had a positive return. However, if you exclude just the top 10 trading days, your return then goes negative. And obviously you can see it's a more pronounced impact as you exclude the top 20, 30, and 40 days. This is just to show you that it's best to stay in the market and committed to the plan for the long term, rather than trying to pick and choose, the best possible days to invest, because that's a very hard game to play, and it can actually end up kind of negatively impacting your returns. And often what we see is that some of the best days and worst days in the market are really, really close together. So just staying invested throughout your plan and having a plan should help you stay confident that your investment plan will be successful. And this is just a little graph to show that. But I'll now pass it off back to Carlos for our third investing principle.
Thank you. So yeah, building a diversified portfolio based on your risk tolerance. This diversification is the process of dividing your money among or across different asset classes, such as the ones that we're going to be talking about today, mainly stocks, bonds, and cash equivalent investments. The one way to spread out risk in your overall portfolio, distributing your investments across and within asset classes, can help your portfolio to be more stable over time, because as one asset class dips in value, another one may remain the same or rise. So first, you got to know your comfort level with temporary losses. As you plan your investment strategy, you need to know how much risk you personally are willing to accept in return of a potential gain. If you're the kind of person who can stomach a short-term loss because you believe that your long-term potential is greater, you may want a portfolio that has greater percentage of stocks. If you'll need the money in a year or two, however, you may want more bonds or cash equivalents because you cannot afford to have a big loss, as you might need your money. Understanding that asset classes behave differently. Knowing how different asset classes have tended to behave in the past can help you create an asset allocation that reflects your risk profile. For example, the stocks tend to move more volatile, but in exchange for that volatility, they tend to outperform other asset classes. If you're comfortable with a certain amount of risk, you may want to include a higher portion of stocks in your portfolio. In a moment, I'm going to show you how a few major asset classes have historically performed. Third, don't chase past performance, meaning this year's top performers may not be next year's top performers. Let's take a look at a couple of charts to demonstrate the difference between the asset classes and the variability. So, as I was saying, asset classes perform differently. Here we have 4 examples. They all started at investing $100,000 from 2000 to 2020. The light blue line is large cap US stocks, meaning all stocks. And you would have ended up with a little over $400,000 by the end of 2020. If you had invested all your money in fixed income, that's a gray line, you wouldn't have made as much, but you wouldn't have had such a bumpy ride. As you can see on the blue one, it kind of went below all the other ones, the light blue. Or you could have played it very safe and kept your money in a cash equivalent, like a treasury note. That's the almost flat line, the dark blue one. And you wouldn't have had any market scares. But what if you combine stocks, bonds, and cash equivalent instruments? That's the yellow line. The yellow line represents a diversified portfolio that is allocated according to the Schwab Moderate Asset Allocation Plan, which makes up for about 60% stocks, 35% bonds, and 5% cash equivalents. By tempering the volatility of stocks with less volatile bonds and cash equivalents, you would have captured some of the growth from stocks with lower volatility over the long term. What this historical example demonstrates is that different asset classes, in this case stocks, bonds, and cash equivalents, tend to perform differently, and combining them can help you create a portfolio with an amount of risk that you can feel comfortable with. So let's look at a different way that you can diversify your portfolio depending on your risk tolerance. So this slide shows sample hypothetical allocation models with the asset breakdowns for each listed from short-term allocation to a highly aggressive plan. You can use these hypothetical examples to build your own portfolio, but the main thing here to look at is the difference of asset allocation and the risk. So as you can see, the short-term allocation is mainly fixed income assets and cash investments. As it moves towards the right, towards a more aggressive model, it has more large equity cap is stocks, usually the largest companies with valuation of 10 million and above. Blue chips, they used to be called as well. But yeah, those are just regular stocks. And the more you have on them, yeah, your portfolio is going to be riskier, but it can create more gains, but it can also have more opportunity for losses. In comparison to a short-term allocation, not as many gains, but not as many losses. So how do you know which one is best for you? Schwab and other financial companies have an investor profile questionnaire that helps you gauge your own risk tolerance and help you decide what type of risk profile is better for you, and mix of stocks or bonds and even other assets that are out there. Now let's talk about another issue that should be considered in your investments besides this, which is maximizing fees and taxes. So back to Kevin.
Yeah, so the fourth principle is to minimize fees and taxes wherever possible. As we talked about a little bit in the second principle, markets are uncertain. So we don't know when there's going to be a large correction or bear market versus a bull market. And again, trying to time the market and know exactly in the short term what the market's going to do is really hard. Obviously, we're confident about a long-term outlook. So if you have a long time horizon, that's something we would want to factor into your investment allocation. But bottom line, we're not certain what the market's going to return, but the fees are certain. So if you have large fees on accounts, that can really eat into your returns and eat into what you're able to ultimately spend, and might even affect, when you're able to retire and other aspects of your financial plan. So it's really important to factor in the cost of the investment that you're choosing and be mindful of the tax implications as well. And with that, you want to pay attention to net returns, net of taxes, net of fees. If you're saving in a 401k, or if you're able to save in a Roth, obviously that's a more tax advantaged vehicle, but there's downsides as well. It might be harder to save money in a Roth, for example, because you need to contribute after tax dollars. So weighing the pros and cons of those is important, and working through that in your financial plan is very important. And we want to minimize taxes and fees along the way wherever possible. If you do minimize taxes, such as in a Roth or 401k, you can see that the compounding effect is greater and you might end up with higher net returns. So we'll take a look here at an example back from Principle 2 as well with Maria and Anna, and take a look at how fees could eat into those total returns. So Maria, for example, if she had no fees, would have had a little over $134,000 saved up over the 20-year period. But if she had even 75 basis points, or 0.75% as a fee, you see that total dollar amount would be reduced to just under 120,000. And then obviously it's reduced even more if you're paying 1.5%, which is a much larger fee, but that has a very large impact on the portfolio, as you have a little over 106,000 if you paid 1.5%. So looking at the cost of your investments, whether it's an advisory fee, whether it's an expense ratio of a mutual fund or an ETF, and in the case of mutual funds, looking at their load fees and other costs associated with those investments is very important, because as you see, it can have a really big impact on your overall returns. Looking at another example as it relates to taxes rather than fees, you can see that returns in a tax-deferred account will give you more total dollars. In that example, you are going to be paying ordinary income tax as you're drawing, so that's important to factor in. But if you sold and had to pay taxes on the gains in a taxable investment account, you can see that that would have much lower returns. So obviously in a Roth, you can get tax-free returns, but again, a little bit harder to save in those with after-tax dollars. So really important as you're looking at your portfolio and making adjustments to it, especially in a taxable account, to be mindful of that impact. And obviously, always in any account, looking at the fees and costs of an investment can have a very large impact on your portfolio. Next, we will pass back to Carlos for Principle 5.
Thank you. So as we were talking before about diversification, the way to avoid significant losses is a portfolio that is diversified across asset classes can lose less value than an all-stock portfolios. While portfolios can incur losses, diversification is designed to help you manage the extent of the decline within the portfolio. Although temporary losses may not be as concerning to some investors, recovering from significant losses can take years. Cash equivalent instruments and bonds are sometimes referred as defensive asset classes because they tend to perform better than stocks whenever they go down. Asset allocation and diversification are two ways to approach managing risk in your portfolio. So let's compare it in the next slide of an all-stock portfolio versus a diversified portfolio. So as I was saying, steep declines are hard to recover from. Here, in recent downturns, an all-stock portfolio took longer than a diversified portfolio to return to its prior peak. The diversified portfolio in this example contained a 60-40 mix of stocks and bonds. We're looking at historical performance for two scenarios, each starting at a base of 100,000 from 2000 to 2020. We'll compare an all-stock portfolio in the light blue, represented by the S&P 500 index, and the one the diversified portfolio, it has the stock portion, the 60% of S&P index and the 40% of a bond index. Bloomberg Berkeley's Capital US Aggregate Bond Index, if you want the whole name, but it's an index that tracks the prices of bonds. So as you can see here, if you owned 100% stock portfolio, you would have seen a 45%-ish decline right away during the first gray bar there. That is the first crash that we're describing right now. If you would have had that 40% decline, it would have taken you 72 months to recover in the ensuing to the point that you were before. However, if you had a diversified portfolio during that time frame, you would have only lost 21%, and it would have only taken you 42 months to recover, assuming you did not sell anything and you rebalanced every quarterly or yearly. Again, like 42 months is a long time as well, but it's less than 72 and you lost less. So what this shows is that the larger the loss, the longer it takes to recover, plain and simple. But staying invested and diversifying your portfolio are good defensive tactics to help you bounce back. So let's look at how bonds and other defensive assets perform compared to stocks during these downturns. Here we're looking at one in 2002 and 2008. The first one in 2002 shows defensive assets that have positive returns that significantly outperform stocks during these downturns. Cash securities, treasuries, precious metals, and international bonds are all defensive assets. This 2002 one was called the tech wreck. It's the one that we had discussed prior. They all outperform stocks. Where we saw losses in 2008, the other example during the Great Recession, the differences were not as pronounced. Like you can tell that precious metals and treasuries didn't go as high, but it did help prevent the loss. Now, with this, talking about this principle, we'll review a couple of other principles that can help you keep up the good work. So rebalancing the portfolio and such.
Yeah, so principle 6 is exactly about that, about rebalancing your portfolio regularly. So as you're reviewing your plan and wanting to make sure that you have some of those defensive assets in your portfolio, it's important to know that the mix and the investment allocation within your portfolio is going to change over time. So if you have a mix of equities and more defensive assets, which are bonds, over a given year, if it equities perform better or stocks perform better than bonds, well, you're going to have a larger percentage now allocated to that asset class, and that's a riskier portfolio. And depending on your risk tolerance, you might not be comfortable with that risk. As you just saw, you can experience some serious declines in stocks. And so it's important to make sure you're rebalancing and staying in line with your risk tolerance needed for your plan to meet your goals. So that's the most important thing. And you want to stay engaged with your investments and your plan to make sure that that investment allocation still makes sense for you. But as long as it does, it's really important to continuously rebalance the portfolio to make sure you're staying in line with the investment that you're comfortable with and staying on track for your goals. As I kind of discussed briefly already, the different, and Carlos did as well, the different asset classes are going to have different performance, and during different market environments they're going to behave differently. And so in those crashes, having the defensive assets is really nice, and during large bull markets everyone wants more stock, but staying true to your risk tolerance is really important because we don't necessarily know what the future is going to hold. And so here is an example of why rebalancing is necessary. As you can see here in this example on the left, if you started with a 60-40 investment allocation in October of 2007 and then went through the Great Recession to February of 2009, you would go from a 60% stock portfolio and 40% bonds all the way down to about 40% in stocks and 60% in bonds. This would leave you with a lower chance to recover from the losses that you experience in equities. So it would be important in this example to sell some of those bonds and asset classes that have performed better in this down market and buy back into the underperforming equities in this example to get back in line with your risk tolerance, so that you do have that chance to recover your portfolio losses a little bit quicker. The converse is also true, as you see on the right side. If you had invested in February 2009 in a 60-40 portfolio and not done any rebalancing, by 2020, you're up to as much as 85% equities. Now, in the crash related to the COVID pandemic, you would have had a more significant decline due to that extra equity exposure. So rebalancing, and in this case, trimming the high performing equities and buying more of those defensive stocks would better position you in line with your risk tolerance. And so, as you can see, over time, the portfolio is going to change, and rebalancing is very important to stay in line with the risk that you're comfortable with. And now I will pass it back to Carlos for our final 7th investing principle.
Thank you. So 7th final, ignore the noise. As we know, like whenever you turn on the financial news, they're all over your face. Like they have bright colors and everything is going down, everything is going up. Like everything is very spectacular and red. And it doesn't help you stay true to your own risk tolerance. And whenever you have a plan and you see all those lights and stuff coming up, it's kind of harder to stay focused. Financial news give advice, they make projections, warn of impending doom and tout sure winners, but they don't know you, and they are really, I mean, they're shows, right? They do give news, but we shouldn't be as reactionary. And markets fluctuate all the time. So when you look at it day by day, it's kind of harder to look at the larger scheme. When you're tempted to abandon your plan or alter it as a result of a dip or a bounce, remember that progress toward your goal is always more important than the short-term performance. So in the next one, I'll go over a little bit more about progress towards your goal. This slide emphasizes that point. Over 20 years, again, 2000 to 2020, markets went up and down. A long-term investor who stuck to the plan would have been rewarded. Here are a few helpful tips that can help from this chart that you can see. While it may be tempting to watch the day-to-day performance, as I was saying, it is always important to remember day-to-day market fluctuations have little impact on your long-term goals. What happens in the short term has little to do with your overall investment outcome. Progress towards your goals is more important than short-term performance. And remember that even strong performers have bad years. Focus on staying diversified and keeping your portfolio allocated appropriately for your goals, risk tolerance, and timetable. because in the long run, diversification can have the greatest impact on successful outcomes. So those are our 7 principles. Tina's going to review more with you.
Yeah, so just recapping the 7 investment principles here, you want to establish a plan as soon as possible based on your goals that are important to you, being realistic about your goals and what you can afford to start saving and investing today, which is the 2nd principle, to start saving money towards those goals and putting the plan into action as soon as possible. 3rd, you want to build a diversified portfolio that's in line with your risk and your goals and investment time horizon. Next, you want to minimize fees and taxes wherever possible, build in protection against significant losses, rebalance regularly, and finally, ignore the noise and stick to the plan. And so with that, we encourage you guys to take ownership as investors and as, people in your community. It's important to take ownership of your financial future. So we always like to say, own your tomorrow, and we encourage you to ask questions and to be engaged. And whether it's here on the call today or with investment professionals that you deal with in your own life, asking those tough questions is really, really important, and being engaged. Specifically, relating to that investment principle around minimizing fees, ask straightforward questions about what the cost of various investments is and how it might work for you and your long-term plan. So with that, we will pause here and kind of open up the floor for any questions that you may have. And I believe this slide will be made available to you as well.
If anybody would like to unmute and ask questions, this would be a great time to ask whatever questions you might have, or you can put them in the chat and I'd be happy to read them. So you can just let us know.
And one thing I'll mention as well is there's tons of resources here online that have free tools and calculators that you can look at and use. And so that might be of benefit to you as well if you want to take a look at some of the free resources that are online to build a plan.
So I'm going to ask you a question, guys. So
Yeah.
Obviously everyone knows the market is pretty wild right now. The world is pretty wild, right? So I know you're probably speaking with a lot of clients about the situation. What is your, I know the changing of the asset classifications is super important and keeping a good balance for your clients. Other than, just your one-on-one information, what kind of general information are you advising people right now?
Yeah, I mean, a lot of what we talked about here is super relevant right now, right? With rebalancing your portfolio. So you might have, a little bit less equity exposure, but this current environment is a little bit unique, I will say, in that, bonds, stocks, and cash, if you look at inflation adjusted returns on cash right now, are all 3 not performing particularly well. And so that's a difficult environment to navigate for sure. But what I would recommend, again, is kind of creating that plan, because what happens here in the next 3 months, we might very well see continued volatility and even some downward pressure, but that can be a buying opportunity as well. And so depending on what your goals are, you want to stay focused on what your goals are and how this might actually be an opportunity. There's opportunities that present themselves in down markets as well as up markets, and so just being mindful of that and how it applies to your situation is important and kind of what I would encourage.
Okay, excellent advice. And if somebody wanted to reach out to you, do you offer like a consultation meeting to start with? How does the relationship work when somebody works with you?
Yeah. So I work with people mainly locally here in the Minneapolis area, but we have several branches as well in Dallas. I believe Swati is in the Dallas Park Cities branch. I used to work with her in Indianapolis. And so she can work with clients in the Park Cities branch, but there is multiple branches in the area, so she's not the only one. But yeah, I mean, you can reach out. You can either online request an appointment with a local branch. So if you find the Schwab branch that's nearest you and you wanted to schedule a meeting with them, you can schedule that one-on-one consultation. There's also on this website here free tools where you can run your own financial plan online. But obviously, if you want the help of a professional, there's local Schwab branches for you. And, you know, there's several other, you know, good firms as well that are in the area that you can speak with. But again, asking those tough questions is what I would stress is important, whether it's Schwab or anywhere else. You know, asking those questions about, you know, what is the costs and what are, you know, some of the negative implications or risks really is important to consider, not just the upside, but the risk as well.
Okay.
I agree with everything that Keenan say, and I wanted to share something. I'm gonna remove it. It's gonna be a website. Can you all see? Can you see my screen?
Yep. It looks like you're on Google.
Yeah. So yeah, I just did this a little bit before the meeting. So back to the diversification point, which I want to emphasize. Right now, this is the S&P performance in the last year. Then US 30-year Treasury yields. Those could be bonds. Those are usually debt. Those are the defensive assets that they're referred to. They're somewhat looked at with this index for 30-year yields. And you can see it has loss, but not as much. And then the 10-year Treasury yield is also uptrending. So yeah, day to day, it's kind of harder to see what's going on, but always try to look at the long term and how things are going. If we were to look at the 5 days of how it's doing this week, it's pretty flat, like kind of hard to tell what's going on. But it's always important to kind of look at the larger scheme and what your goals are and where you want to be. So yeah, it's really just back to that. Like, you might be hearing everything in the news right now, and yeah, it's always unprecedented times, and we've never seen anything like this. Just stay tight, stick to your plan, make a plan. If you're not investing yet, then start doing so. If you have debt, try to pay it. Those basic things you can always start today.
Yeah, I agree completely. And that's why it's so important to know what your risk tolerance is, because over time, over the long run, the most return is going to come from equities. But as you see, when things are going poorly in the market, that's also, you know, what's going to hurt you the most. So it's important to know, you know, what type of risk you're comfortable with, because if you're not comfortable with a certain level of risk and it's going to cause you to want to sell your investments when they go down, then you're locking in a loss that is actually going to probably hurt you in the long run. So, you know, if you're not comfortable with a certain level of risk, it really could end up hurting you in the long run. But, you know, the more risk you are comfortable with, the more return you're likely going to get in the long run. So really important to take a look at yourself and your situation to see both what you're comfortable with personally and, you know, what makes sense with your investment time horizon. If you have a longer time horizon, you can generally afford to be a little bit riskier, but, you know, you have to be comfortable with the level of risk you're investing.
That's excellent advice. Thank you so much for that. Did anybody have any questions that they'd like to ask at this time? Okay, I'm going to put a quick poll out there for you. If anybody, if you can answer it, that would be great. If you found the workshop effective. Let me do the launch. It might help if I launched it. There you go. Okay. Got 100% that everyone found the workshop effective. So thank you for that. And we're so glad that you all could join us today for our special webinar presentations. Next month, we'll be talking about Banking 101 and how to find the right bank for you. That'll be the first and third Thursday of July. And then in August, we'll be talking about mortgage. And a lot's going on in the mortgage interest rate industry right now with interest rates. And we'll be talking about how to qualify to buy a home in August. So we will have lots of exciting topics coming up, and we appreciate you coming to our Investing 101 webinar today, and we hope that you'll join us again. Thank you so much, everyone, for joining, and thank you, Keenan and Carlos, for taking time out of your day to make this a very special presentation. Thank you so much, everyone. Enjoy the rest. Oh, I've got some chats. Let's see what people
Yeah,
are. Everyone is thanking you, so I'll thank you as well. And I look forward to seeing everybody again soon. Thank you both.
yeah, thanks for having us.
Thank you. Take care. Bye.